Hey there, awesome accounting student. Mark Franke here. This video is for Accounting 100, Chapter 5. We're going to talk about adjustments and the worksheet. So we've so far learned to record transactions into the accounting equation. Owner puts money into the business. We pay the rent. We perform services on account. We perform services for cash. We buy supplies, buy equipment on account, or whatever it is, we know how to record these transactions. However, before we can prepare financial statements that are accurate, we need to make adjustments for certain things that may be impaired. So what I mean by that is if we bought supplies, some of those supplies may have gotten used up. If we paid for some insurance, some of that insurance may have been used up. If we bought a piece of equipment that we're going to use for 5 years, some of that 5 years has now gone by. We've used the equipment. It has depreciated. And we also may need to accrue for things. But in this case, this is problem 5-4B, and this is in your book on page 159. Page 159. What they've given us is a trial balance, and I have set up a worksheet, what's called a worksheet, with those beginning balances. So this company is the Estate Planning and Investments Company. The cash balance is $78,800. This comes right from your book. The total debits and credits is $578,800. So what we're going to do is we're going to prepare some adjustments and put them in the adjustments column, and then we'll get new trial balance numbers, and then we'll be able to prepare the income statement and balance sheet from the worksheet. We'll complete the worksheet. So the first journal entry is for supplies. It says, and this is on page 160, item A, supplies were purchased on June 1st. Inventory of supplies on June 30th showed a value of $12,000. Inventory of supplies means that we went out and counted them, and that's how much was left. So we're going to have to do a calculation because our adjustment is for the supplies that got used. So we're always going to do these at the end of the period, in this case, June 30th. And I know I'm going to debit supplies expense because expenses are always debits, and I'm going to credit supplies. Supplies is an asset. It went down because we used some of the supplies. But I need to do a calculation, so I'm going to show the calculation right here in the journal. My description says to record supplies used. That's the adjustment. We started with supplies that we bought, or we'll just say the balance in supplies was $30,400. The supplies on hand, that's what we counted, is $12,000. In other words, those are the supplies that we didn't use. How do we know we didn't use them? We still have them. So supplies used is the difference, $18,400. I'm going to draw a line because I did a math function. And the debit of $18,400 goes to supplies expense, and the credit goes to supplies. Supplies is going down. So the ending balance in supplies when we're done should be $12,000, which represents the supplies that we still have. By the way, I forgot to put the name of the company in here, so I'll do that now. Estate Planning and Investments Company. And then we'll move on to adjustment B. Adjustment B says, the prepaid advertising contract was signed on June 1st and covers a 4-month period. So if we look at what's in the prepaid insurance account, prepaid advertising, we have $57,600. Again, that's on the trial balance. So it was a 4-month contract for advertising, and now 1 month has gone by. So on 6/30, we're going to be debiting advertising expense and credit prepaid advertising. Prepaid advertising is an asset. It's going down because we used some of the advertising. So this is to record expired advertising. And we have to prepare a schedule. So the balance in prepaid advertising is $57,600. The number of months in the contract, this was an advertising contract that covered 4 months. So the monthly expense is $57,400 divided by 4, or $14,400. I'm going to draw a line and then plug the numbers in up above. Debit advertising expense, $14,400, and credit prepaid advertising, $14,400. Adjustment C says rent of $12,000 expired during the month. If you look on the trial balance, we have an account called prepaid rent. It has a whopping $144,000 in it, but that looks like we prepaid a whole year and $12,000 has now expired. So we don't need to do a calculation in this case. All we need to do is write off $12,000 from the prepaid rent account. So we're going to debit rent expense and credit prepaid rent. And this is to write off expired rent or something like that. Every journal entry needs a description of some sort. And then our fourth journal entry is depreciation on the equipment. It says that they use the straight line method. The equipment has an estimated useful life of 5 years and no salvage value. Estimated useful life of 5 years and no salvage value. So I'm going to put in the date. And in this case, we're going to have to do a calculation, and I will show you how it's done. But the accounts that we're going to use is our depreciation expense. And notice that all 4 of these entries, the debit goes to some sort of an expense account. In this case, it's depreciation expense. And we're going to learn a new account called accumulated depreciation equipment. And we could even say depreciation expense equipment if we want, although there's only one depreciation account, but we'll do it anyway. And this is to record depreciation for the month, or something like that. We're going to start with the cost of the equipment, which is $192,000. How do I know? I go to the worksheet. The trial balance tells me $192,000. We haven't recorded any depreciation on this asset, so $192,000 is there. They told us the estimated salvage value is 0. Now, that is not typical, because if we use a piece of equipment for 5 years, it's probably going to be worth something, even just the scrap value of the metal. But the assumption here is, or what they told us, is the estimated salvage value is 0. But we would normally have a salvage value, and that's why I wanted to show it here, even though it's 0 in this case. So our total depreciation, that means from the time we started using it to the time that we're going to not use it anymore, which is 5 years, we're going to depreciate $192,000, which means it's going to go down to 0. Again, that's not typical, but that's the facts they gave us. The estimated useful life in months. We're only recording 1 month of depreciation here. It's 65 years. So our monthly depreciation is $3,200 on this piece of equipment, debit depreciation expense, and credit accumulated depreciation equipment. Accumulated depreciation equipment is an asset account, but it's a contra asset account. It's a negative asset account. It is married together with the equipment account. We have to have 2 accounts when we're talking about a long-term asset like this. We have the cost of the equipment and we have the accumulated depreciation. Okay, so now I'm going to take and post these 4 adjustments: supplies, advertising, rent, and depreciation, into my worksheet in this adjustments column. So I'm going to stop the video. You can do this yourself and then calculate new balances in all of the accounts. I'll be right back. Do it on your own and then compare to mine. Okay, so I have posted these adjustments and I've used the references A, B, C, D, and I've done this in red. This is a very common thing that accountants do, is these kinds of references in a red pencil. But obviously in Excel, I have formatted it to be red, and I total it up, and my debits equal credits, 48,000. So the next step is to prepare adjusted balances. Cash and accounts receivable didn't change, so I just brought those over. Supplies, we're going to add the debit, subtract the credit. Supplies is 12,000. That's how much supplies were on hand. Prepaid advertising now has a balance of 43,200. Prepaid rent now has a balance of 132,000. The equipment cost didn't change. My accumulated depreciation did not have a beginning balance, so my adjustment is the balance. Accounts payable didn't change. The capital account didn't change. The drawing account didn't change. The revenue account, fees, income didn't change. But we have now 14,004 in advertising expense, 3,200 in depreciation expense. Rent is 12,000. Salaries is 30,400. Supplies 18,004, and utilities is 5,200. So when I total these up, I've got to balance out, and 554. Aha, this is wrong. Okay, good. There we go. 582,000 is the correct number. And we should get 582 on the credit side. So debits equal credits. So our last step is to spread these accounts. Our total debits equal total credits. You can't go forward until that works properly. And then we need to put the items on the income statement, which is the fees income, and all of the expenses are going to come over. So our income statement is a revenue, fees income, minus the expenses. So when I total up the expenses in the worksheet, I get total expenses of $83,600. I only had one revenue account, $295,200. So net income is going to be the difference between revenue of $295,200 and expense of $83,600. So my net income is $211,600. In other words, revenue is $211,600 more than expenses. So in order to balance out these two columns, I put the net income on the debit side because the debit side is lower. And now I'm going to go and bring over all of the balance sheet accounts. Cash, accounts receivable, supplies, prepaid advertising, prepaid rent, equipment, depreciation, accumulated depreciation, accounts payable, the capital, and the drawing account. So when I total this up, all the debits, $498,400, all the credits, $286,800. I'm going to pull over net income, and that should balance out my balance sheet columns. Now, this is not a balance sheet, and this is not an income statement. This is just a tool for using for being able to prepare the financial statements. So now we can prepare the financial statements from this schedule. Revenue minus expense, then the statement of capital, owner's equity, is going to take the drawing account into account, and then we're going to balance out the balance sheet. So I've prepared a template, a work paper for you to do the financial statements. Take a few minutes, prepare the financial statements from this worksheet, and I'll do it here, and I'll be right back. Okay, I'm back. Here are the financial statements. Income statement, we got our same net income. We have to. We already calculated that on the worksheet. Revenue minus the expenses, and I've listed the expenses out. And $ top and bottom. We don't put $ on every number. We only use a $ at the top and a $ at the bottom with double lines or railroad tracks at the end. Statement of owner's equity. Our beginning balance, there was no capital contributions that happened during the month. We have our net income, less the drawing, $16,000, and our ending capital is $436,000. That plugs into the balance sheet. Balance sheet lists all the assets in order. Notice that accumulated depreciation is a negative asset. That's why it's shown with parentheses or brackets around it. So it's negative. It's a credit balance account. It's a contra asset. Then our accounts payable is our only liability, and then capital is coming from the statement of owner's equity, and everything balances out. This is going to take some practice. I would suggest you do this problem over again, maybe even a couple of times until you can do it. We're making adjusting journal entries, we're posting them to the worksheet, and then we're preparing financial statements. This is something accountants do every single month, every single quarter, every single year. It's an ongoing process. Every single time we're going to prepare financial statements, we have to go through this process of making adjustments for assets that have been impaired. All right, that's it for this video. Thanks for watching. Practice, and I'll see you again next time. Bye-bye.